Good morning, and thanks for joining us here on Treasure Coast Solutions. Wednesday mornings on the show here, we talk about things that are going on in the economics world, things that are happening financially overseas in the U.S. and locally. It's not a financial planning show, but it certainly could help you plan your future, I think, in terms of what you might expect financially coming up. And in general, we're kind of just talking about some of the things that happen in what they call the dismal science, which is economics. And the reason it's called that is because, unfortunately, it is a science. It's not the dismal arts, and it's a and as a science, it's something that can be tested. There are hypotheses and things that can be tested and that are proven, and things that are proven to be wrong. Those things, it's not quite as easy as the test tube type stuff, but over a 200 or 300 or 500 year period of time, you can kind of see what's happening. And it's interesting that in economics, a lot of the history, dovetails as well, because which, it's kind of a chicken and egg thing, but which came first, the problem or the solution, or the problem or the economic outcome. It's kind of those kinds of economic problems impact what happens in history. What kind of things take place. For example, there was a country. There was a place. A bunch of people got together and got tired of people taxing their beverages, particularly their tea, and they decided to dump it all and form their own country. And that was all based on the economics of the situation, the taxes. A few years later, they started to tax alcohol, and we all know that's a mistake. So that one ended in a revolution as well, the whiskey rebellion. So when you look at some of these things, the economics of what's happening, the taxes, the things that are happening economically are impacting history and vice versa. So it's kind of an interesting thing to look at, and it's interesting to look at where we are now and where, maybe historically what we would potentially expect, and what kind of outcomes we would suspect. So that's kind of what we do, is we're talking about a little of these things, some of these things, trying to get some advanced understanding of what the risks are and what the potential problem is. So my name is Mark Breckbill. I'm a CPA, and I'm also a ex-banker. I spent a number of years in finance, in particular, managed investment portfolios internally for banks as their chief financial officer or their controller, but more specifically as their chief financial officer, managed their investments, and also managed the economics and the interest rate exposures of banks. So I dealt with the Federal Reserve, and I dealt with other financial institutions, large money center banks and non-money center banks, and all of those kind of things. It was kind of an interesting process because you learned a lot about some of the risks that exist in our financial system, and how those risks can be exacerbated and how they can be minimized sometimes, and what happens when you don't. So it's been an interesting process. I can't complain about some of those experiences, even though at the time it wasn't real pleasant when I was going through them, but it's been a learning experience. So we've been talking on the show here about some of the issues, some of the things going on with inflation. I hopefully some of you that have been listening on a regular basis and then kind of watching what's going on in the economy are starting to see some of the stuff that I've been talking about relative to inflation, and the fact that the Fed really can't control it. They can say that they're not going to raise interest rates, but they don't have any control over that. So, and you're starting to see a little bit of the panic. And here's the problem. When politicians, and even to some degree, economists and accountants, uh, they might be able to project the overall trend. So I could say, for example, uh, I think we're going to have inflation, and I can make that statement that in the next 10 years we're going to have fairly significant inflation. I think that I could say that fairly comfortably using um, the word fairly significant leaves me a lot of option, right? And using the 10-year horizon or so gives me I could be pretty safe saying that. So the more general I am, but the more specific you need to be, the harder it is. So if now, um, which I was kind of pinned down the other day, purposely pinned myself down on it, but the question came up, what do I see happening with interest rates and inflation? And yeah, I've seen the projections out there from the banks and the economists, the brokerage firms saying, oh, I think we're going to see maybe maybe a 1% inflation this year, and then maybe moving up to 1.5, maybe 2%, and staying there for about 2 or 3 years, and so a gradual increase, over which doesn't preclude what my statement before, that I think we're going to see some fairly significant inflation over a 10-year horizon, because even with what they're projecting, by the time you get to the end of the 10 years, you're going to see a fairly significant rise in interest rates and in inflation. And that's going to, it would just be impacted just by little steady increases. But the difference is that if you get steady increases in inflation and interest rates, the economy can adapt to that pretty easy. So I can make an adjustment there, and I can push a half a point or a 1% increase. I can push that through as a price increase without much trouble, or at least not as much trouble as it would be if it was a 10% increase. So so how fast the problem occurs, the inflation occurs, is more difficult to get, but it is the crux of the problem. Because if instead of a 2 or 3% increase in interest rates over a 3-year period of time, we have a 6% increase in interest rates over a 7 or 8 or 9 month period of time, that's a much more difficult scenario. That's a much more difficult situation. So it's much more of a problem. And frankly, that's the type of problem that I see. I personally see, because this whole process, there's too many factors in there that can't be managed, that are already at a point where they're like, I refer to the rubber band that's already been stretched, and all somebody has to do is let go, and it isn't going to go because it's already stretched out there as far as it can go. So when you let go, it's going to go as far as it can go. It's not going to go 1 inch. It's not like it's just going to fall out of your hand. This thing's going to take off. And the reason I say that is there are a lot of things out there that would indicate that is a problem. Money supply being the big thing. There is an awful lot of money in the system that normally wouldn't be there. The Fed would be tightening it up. They'd be pulling it out. But as I mentioned on a previous show, the risk of money in the money supply is a two-factor. There are two factors in the money supply that affect interest rates and inflation and things like that. One is the amount of the funds, the amount of the money supply, the amount of the money that's out there. That is as big as it's ever been. And in fact, if you just looked at that based on historical calculations, we would have already been draining the system of some of that money supply. Instead of pumping it back in, we've actually been feeding it. We would be pulling it out. We would be trying to extract it from the system. And but and here's, as I say, this is a science. We test things out, and over a period of time, we get results, and we learn that we're right or wrong. With money supply, Milton Friedman, of course, was the big economist that was the person that was, kind of the father of the money supply theory, and he one of the things that was assumed in his calculation was that the multiplier, how rapidly money turns over, or conversely, how long people sit on their money without spending it. How rapidly does cash change hands? Does it turn over? That was more or less a constant. That there wasn't any variance in that. Well, we have found that that's not true. That it's not a constant. That it can change. And so what's happened right now is the reason the money supply is not an issue right now is that the multiplier is about zero. I mean, there's no turnover of those funds. They're sitting in corporate savings accounts, primarily corporate bank accounts, presumably prepared to acquire companies, but nothing's happened yet. There has been some acquisitions, but not nearly the amount of acquisitions. And some of the big companies like Apple, they have huge amounts of money. But what they've done, and many of them have done, is instead of spending that money and acquiring other businesses or expanding their operation, what they've done is bought back their own stock. So what they've provided it as a return to shareholders rather than as as pushing it into the system. Now, that doesn't, depending upon how they return it to the shareholders, so if they do it as dividends, which the tech companies don't typically do, they do it as dividends, then that's going to go out and that's going to go to the consumer, and the consumer is going to pretty much, spend it. But if it's going out as a buyback of stock, then typically that money is being reinvested. It might have been reinvested in more stock, so if you didn't want to sell your Apple stock and they bought it back, you might sell it back to them, but you might buy it back later. You might reinvest in something else. So you're not necessarily spending it, you're saving it. So that's kind of where we're at from the money supply standpoint. Now, the other side of the coin is basic inflation, and there's the feeling in the economy that we don't have inflation. Inflation is under control. Well, I think, and here's where I think that the everyday person that's on the street, like myself, or like most of the people probably listening, that aren't sitting in an ivory tower or a lab someplace trying to, just looking at numbers and not looking at what's going on in the real world. We know what's happening. We know what the price of a PVC pipe has gone to. We know because we've tried to fix our sprinkler system. We know what the cost of pavers are. We know what the cost of a 2x4 is. And we also know of people that are getting raises, nurses that are being paid bonuses to provide certain jobs, restaurant workers that are being paid extra to come back, people that have been affected and by the minimum wage, new teachers who have been given an increase in salary. What happens is we look at those individually and we don't put it all together. But when you put all of that together, we're seeing a significant increase in the price of materials and labor. That's what makes inflation. So if we get it, and the problem is that we're still tied down here. But when the economy takes back off, and starts accelerating, which it's starting to do, we're pumping billions of dollars, trillions of dollars into the system. The system is revved up. I mean, we're pouring fuel on the flames at this point, and it's just getting bigger and bigger. And as we do that, the economy, think of the rubber band, is stretched as far as it can stretch. And at some point, we're going to let it go. Well, the problem is that that thing might go a long way, but the inflation is going to go with it. In other words, to produce the products and to produce the items that we need, you're going to have um, employees, and there's going to be competition for those employees, because some of these employees still don't want to come back. Some of them are now retired. They sold their business, got out. They're not providing that service anymore. There's been consolidation in certain industries, and people have changed. There's not the capacity that there used to be. Even we're seeing this huge increase in home buying. You look at the home and the housing costs are going up, but new houses aren't coming online. So what's happening is more and more strain is being put on the existing housing market and the existing housing inventory, because there is no new inventory coming online. Why? Not because they can't sell the houses. Lennar and Pulte and all those, they can sell hundreds and hundreds and hundreds of houses. In fact, they have sold probably that many in just tradition, but they can't deliver them because you can't get refrigerators, you can't get stoves, you can't get two by fours, you can't get pavers and pool decks, you can't get for a while you couldn't get certain roofing material. Anything that's tied to oil has gone up significantly, and if it hasn't, it's being priced as if it has, because of the anticipation of a significant increase in fuel costs or in oil costs. So all of that's already happened. It's already built in. The system has already got it. So when that rubber band is released, it's going to take off. Now, the question there is how far it's going to go, and how fast it goes. The faster and the higher it goes, the sooner that it will come back down. For example, the Jimmy Carter interest rates. They went up initially to about, at the time, what happened is that in the banking industry, it's kind of interesting. That was when money market accounts started. I don't know if, many of you probably are not old enough to remember, but in the day, you couldn't go into your bank and get, a 3% or 5% or whatever rate. The only way you got a negotiated rate on your savings was if you could do a CD of $100,000 or more. Then you could go into your bank and you could negotiate with your bank on that interest rate, especially if it was like a 30-day, 60-day, 90-day, and you could get an interest rate. But there was no interest-bearing account that you could get your money out of right away, and there was nothing like that. You had passbook savings accounts that you could bring your passbook in, and you might have made a few pennies, hardly anything, but nothing near whatever the market rates were, unless you pooled your funds. So, for example, down in Palm Beach County, there were many of the large housing developments and condo developments. For example, Century Village down there, they used to have investment clubs. And they would get a bunch of neighbors who had $10,000 or $15,000, and they would get together and they would pool their funds and get 100, 200, 300. And then they would go into the local banks, and they would go to each one of the local banks and they say, I've got $300,000. What will you give me for a 90-day CD? And they would negotiate to the eighth of a point. They would negotiate that rate. And frankly, if you were off by an eighth of a point, you didn't get that money. But if you were there, you got it. So that's what happened until the money market came around. The money market account came around, and then the government deregulated the interest rates on savings accounts so that money market accounts could be, you could pay market interest rates. Well, there were two things going on with that. One, market interest rates were pretty low at the time. I think at the time that they deregulated, the interest rate was like 5%, 5.5%, somewhere in that range, maybe even a little less. But so that wasn't a big deal. It was not a huge situation where there was but a lot of money flowed into those rates that were now changing daily, not every 90 days, every 120 days, every 3 years, where they had been long-term CDs. Now they're, now they were overnight CDs or, 60-day CDs, and they could get to their money right away. And the money market account, you could actually get to your money immediately. Now, if you remember, and it still exists today, and people wonder why that's there, with a money market account, you're limited on the number of transactions you can have per month. You're allowed 3 checks, I think, and 6 withdrawals. I don't remember, if you've got some restrictions on the deposit side. I don't think so. But on the, so why is that? Well, that's so that didn't become a checking account, because if it was a checking account with interest rate on it, you weren't allowed to do that in those days. And it was also to keep, as I mentioned on a previous show, one of the things, one of the only real tools the Fed has to control the amount to control very short-term interest rates is how much money they require that banks maintain on deposit with the Federal Reserve to cover their deposit accounts, in particular their checking accounts. The Federal Reserve maintains reserves from each bank in case somebody has a run, so to speak, on their bank. And the way they would have a run on their bank is in the old days is that they would they pull it out of their checking account. Now they could come in and cash in their savings account, but the idea was that they didn't want you to have a checking account that there's no reserves on, and you're getting a market interest rate. A lot of that's loosened up now, but there's still restrictions on money market accounts that the banks have on, so that they don't become checking accounts that the bank has to maintain reserves on. Because if they have to maintain reserves, that's less money they can loan out, less money they make, and they then have to, they have to kind of charge more. So that pushes interest rates up. So that's where we were back in those days with Carter, and then the interest rates suddenly went up. And it was all pretty much, but they went up pretty rapidly, and they went from about 5% to about 12% in less than 6 months. But then they came down right away, right after that. For one thing, because the economy was kind of shocked by it, and the consumer changed their behavior because nobody knew what was going on. And in fact, at that point, the interest rates with them that high, people started pulling money out of things like stocks and other investments and putting them into treasury securities, bonds, and things like that. So they basically took it all out and left it on the sideline. They put it into savings, and they just parked it, and they didn't spend it. And of course, then the money supply was getting bigger at that point. But and because interest rates had gone up, the demand for money, individuals borrowing money from banks, the demand for money went down because of the rate of the interest rates. Many people didn't, they didn't want to get tied into those kind of rates long term. So many of them borrowed short term so that they wouldn't have to tie in those rates long term. Those rates came back down pretty quickly. And then about 4 months later, 3 or 4 months later, they skyrocketed. People forget that there was actually a double peak and a double dip, but there was a double peak in interest rates in the Carter in the latter. I think that was in 78 or somewhere in that range, in that Carter era. That there was a twofold one. So there was one that hit, and everybody was so shocked they didn't really realize why it was occurring. And then it hit again, and it hit big time. And prime went to 21%. Mortgage rates went to fixed rate 30-year mortgage rates went to 16%. And, it was crazy. In fact, all kinds of new products came out. Remember that the adjustable rate mortgage came out because people couldn't afford it. There was negative amortization loans where your payment was not enough to cover interest for the first couple of years, and that got added to the principal at the end. So all because nobody could afford anything at those interest rates. Nobody could afford those types of prices, and because the market went so high so fast, the market collapsed on itself, and then and it fell apart because those rates were not sustainable. The economy was not able to sustain what was going on, so the U.S. economy, basically collapsed. But the world economy was collapsing too, because those interest rates were being affected. The interest rates were being affected around the world. It wasn't just in the United States, but so that's what happened, and we had people buying gold. We had a lot of things happening then, and the market eventually, and the housing market collapsed in certain areas. There was problems there. Employment collapsed because inflation was so high. People couldn't afford, they couldn't afford to buy a home. They couldn't afford to move. Nobody could change jobs. So it was a very difficult time. But again, had that same increase gone from 5 to 20%, had that taken place over a 7 or 8 or 9 year period of time, we probably could have handled that. But we can't, not that fast. The business can't adapt to it. Wages can't adapt to it. Pricing can't adapt to it that quickly. And so when you get hyperinflation like that, it either forces the economy to collapse. But what actually happens, and it has happening there, is there's a scarcity of goods. There's the inability to buy things. People don't have the disposable income. They have to actually spend their money. They don't have savings because savings gets chewed up by inflation. So people have a tendency to spend right away. In fact, they tend to borrow and spend, and it creates a very it creates a spiraling type of effect. And then the other thing that happens is that the government ends up having to borrow a large amount of money. Now, if we've got a big deficit because the economy is not functioning, that deficit has got to be funded if the government continues to provide the same services. Well, every time there's a crisis, we've seen that with COVID. Anytime there's a crisis, the government feels like they have to support the economy. And I know we all need that, because the fact of the matter is we'd be out of business. Some of us would be out of business. And but looking at this purely objectively, should some of us be out of business? And the answer to that is probably yes. If you're 65 years old and you're in the CPA business, should you be out so that younger people can take your place and maybe make a higher wage? Now, if I don't have to get out, I can still make pretty good money, maybe into my 70s or 80s. So I'm not necessarily going to retire. But had the economy continued to go where it was going and no bailout, I probably would have said, "Oh, okay, I'll sell. I'm going to hedge my bet. I'm out of here." And that's what a lot of business owners have done. So that's the other thing that we're going to see. We're going to see a consolidation. We're going to see certain types of industries that are going to go from fairly competitive industries where price is fairly competitive to a situation where there's only a handful of producers, because the competition is going to fall out. At some point when those interest rates go up and the government's no longer supporting you, or even if they are supporting you, they're taxing the money all away to do that, then you're not going to be able to survive. And that's what's happening. And frankly, right now there's most businesses where the owners are near retirement. I'd say between 60 and up, and maybe even 55, depending on the industry. Now's a good time to sell. You're going to get maximum price. If you get it done before the end of the year, tax rates aren't going to take it all away. And you've got an opportunity to shelter it. If you hold on to it, anybody out there who's thinking about holding on to their business, and just waiting to see, a couple more years, I'm going to do this a couple more years, you are committing right now to being in your business for at least 10. This is not the type of thing that's going to be a couple years, unless you're willing to just walk away from your business. Maybe it's just an income stream for you and you don't care about the business itself. And you're just say, well, I'll just run it out to the point that I can, and then I'll just walk away from it. But if you were planning on selling it and getting any value from it, using that money for retirement, you better figure that you're either out in the next year or you're in for the next 10, because it's that's kind of where we are in this inflation cycle. It's interesting that business cycles used to run 3 to 5 years. So you used to have a situation where, where you would go through this and it would be a process, and stocks would, you'd have a bear market, and then you'd have a bull market, and the distance between those two was usually at least 3 years, maybe as many as 5. Over the last 10 years or so, that has not necessarily been the case, although the bear market that we had, or and I'm going to take stocks out of them, talk about the economy then, because they're two different things. But in 2007 and 8 and 9 and 10, when we had, probably the worst economy that we've had since the Great Depression, and it continued, we didn't have any kind of recovery from that. Even though people said, "Oh, we produced jobs," we produced low-income jobs. We produced a lot of jobs that won't support the economy. They were second jobs, and there was a lot of those out there because you had to work 2 jobs to make enough money to survive. And so we had a lot of that, and we had an economy with, that was really very, 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 very poor in terms of how it was working. Nobody wants to talk about that, but it was. And so in that period of time, we were in a recession, in effect, or an economic cycle that probably lasted about 5 years, maybe a little longer than that. That might not have been the actual definition from an economic standpoint, but from a pure business standpoint, anybody that went through it knows that we really were in a bad period of time. And a lot of people think that that the housing market collapsed in 2007, and so that's where we think was the low prices, and then they started coming back, but they did not. They collapsed in 2007, and then they collapsed again in 2008, then they collapsed again in 2009, and in 2009 we hit the bottom of the pricing market for the last time. Then it was from there that it started going up. So it took us a while, because from 2005 prices, 2006 prices, which were the highest in the real estate market, until now, we went down quite a bit. I mean, in some cases, 50% down or 60% down. So it took a while for us to come back up. And we had a horrendous time because a lot of people lost their jobs, and their houses went into foreclosure, and condo associations and homeowners associations had to file liens and foreclosed on assessments so that they could get money to pay the operations. So we had a longer cycle then. And the reason we had a longer cycle is because we stepped in and interfered with the process. So what we did is in 2007, we basically, in 2007, we basically kind of cut our wrists, and then we put a tourniquet on it somewhere into 2008, and we tightened it up a little bit, but then we let it keep bleeding. And then we just let it keep bleeding a little more until the point that we weren't sad. We had stopped. We didn't die, but we weren't really feeling really good, and that was because primarily Larry Summers, who was the Secretary of the Treasury at the time, prevented the depression that should have come. And so what we should have had was the downturn that we got in 2007. The market was out of control. We should have gotten that downturn that we got in 2007. And then we should have had an immediate collapse in 2007 and into maybe the beginning of 2008. And then we should have started a recovery. All of the players would have gone bankrupt. We would have had, the banks would have gone out of business. The big banks that were the the inefficient producers like General Motors would have been out of business. All of these entities that were, either inefficient organizations or monopolies that shouldn't have had control would have been gone. And new businesses and new owners and new management and new people would have come in, and they would have learned the lesson from the previous situation, and they would have taken off, and the economy would have become much stronger. And we would have had strong banks and a strong financial system, because they would know they wouldn't make those mistakes again, because they know what happened the last time that mistake was made. The bank didn't exist. The people didn't have jobs. These CEOs were unemployed, and they weren't getting it. That's what would have happened. That's what happened in the 20s. That's what happened in the 1800s. That's what happened. Those people lost their power. They lost their jobs. They lost, what control they had, and the economy rebuilt. Now, it's still going to make mistakes, and the economy is still going to allow certain things to become monopolies, and all those kind of things. So the economy is not going to correct itself perfectly. It still has to be monitored, but it would have corrected itself quickly. So, would we have had a depression? Yes. Would it have lasted for a few years? Probably 2, 3, 4, but it would have been deeper and quicker on recovery, and we would have gotten rid of people who are now going to cause the next problem, and that is the banks. Right now, try to borrow money from a bank. Because the government has given out all kinds of money, the banks don't want a loan. I just heard one today, a deal where companies got, they own a bunch of land free and clear. They're in the agricultural business. They need to put up some buildings. The buildings are going to cost, maybe 600,000, 500,000, and they've got, they own their home free and clear. They own rental properties free and clear. They have all of these things free and clear. But they want to borrow, $500,000 from a bank, a big bank, and that big bank says, "Well, we're not going to do it because the SBA has a lien. They have a UCC filed on all your stuff." Well, first of all, you can get that lien removed. Especially for inventory or for things that you're doing like this for construction, because it's an unsecured guarantee and it's an unsecured UCC, and in effect, it's a blanket UCC. So if the bank wanted to, they could get it released. They don't want to. They don't want to be behind the SBA. Now, there is plenty of equity out there, but we're talking a 40% loan to value, maybe, when you consider some of the other things, and they're not going to do the loan because of collateral. Well, banks are not collateral lenders. They're not supposed to lend based on just collateral. They're supposed to look at character. They're supposed to look at credit. They're supposed to look at all kinds of other things, cash flows, things like that. Not just, not just what, the collateral looks like. So, but that's what's happening. And who's it happening to? The big banks, because the big banks were allowed to survive. So they've learned that if I obey the government, and if I don't do these things, but if I obey the government, I will be preserved. So they're not going to do something that they don't want to do, because they don't want to get in that position. And so therefore, they're not going to go out and loan money. Their job is to loan money. What banks are not investment vehicles. They're not something that you put your money into to earn a return. That's not what a bank does. A bank is a credit intermediary. They take one party and they act as an intermediary between them and another party, the depositors. And in that mediation, they get paid for that. They get paid for evaluating and assuming risk, because the bank has got the risk. So they get paid for assuming risk, whether it's credit risk, the fact that the business won't repay, or it's interest rate risk, the fact that interest rates will go up and the person and their costs of money will go up and their interest rate on their loan won't. That's a 30-year mortgage. So that's what happened. And those banks are now out there, but they're not players. And we need them right now. They need to be in the market. They need to be out there helping business get out of this, because business isn't going to have, no matter what the government has done at this point, businesses are not going to have the working capital to get through all of this, especially down the road. Now, here's the other thing that I'll mention, and it's something to keep in mind, is that if you've borrowed money on the PPP and you've gotten that money forgiven, that doesn't have any long-term impact on you. All right. It was good for you. It got some money into the hands, but most people that know the PPP loans know that money really, all the businesses were, especially the small businesses, all we did was collect money for from the government and give it to the employee. We were an unemployment office is what we were, but we were a good unemployment office because we did it quickly. And it goes to show, when you cut out the certain sections of the private sector, of the public sector, you can do those things quickly. Who could have imagined how fast we got money into the hands of employees if we'd have gone through, well, we saw when people got laid off and they had to go through the state unemployment office, it wasn't equipped to handle that kind of volume. It was already a bad system, and it wasn't equipped to handle the volume that it got. It collapsed. Why? Because public entities aren't geared up. They're not geared up for that kind of thing. Private entities are. We pay people every week, so we could get money into their hands weekly if you give it to us. So we were very efficient on that, but that was money that came in and came out. It didn't really do a lot for the businesses, particularly while they were shut down, because we weren't generating any revenue from that money. It would be one thing is if we were continued to work at full capacity, kind of like the second PPP, maybe we were working at more full capacity, and then we're keeping the profits and we're getting our costs subsidized. That we might have made some money. But for most of us, it was not the case. It was just we were pumping the money through. So then the other thing was the economic injury disaster loans, and the EIDLs, and those are loans. So think about it a minute. If you're maxing those were originally based on 6 months worth of gross profit. So your total sales less your material costs, gross profit. It was based on 6 months of that. So they were giving you enough to cover 6 months of those costs that you were borrowing. You had to pay it back. But the idea was that within 6 months, the economy would be going full bore. You'd be able to pay that back over 30 years, and it wouldn't have an impact on you. 30-year payback on the loan, you'd be in good shape. But now what's happened, and that was supposed to be, but the other side of that is the money you would get was supposed to be the amount of that gross profit. Well, if your gross profit was $500,000, then you got $500,000. If your gross profit for that 6 months was $2 million, you got $2 million. And that was the cap. There were different collateral requirements, different borrowing requirements, but basically you could get a loan up to $2 million. If you wanted anything above that, you had to specifically appeal that to the SBA itself, to Washington and the Secretary of the Treasury or something like that. And but what happened is that the government arbitrarily came in. They arbitrarily came in and said, well, we're not going to have enough money, so we're going to cap this at $150,000. Well, unfortunately, $150,000 wasn't enough for most people. Anybody that needed 500 or 2 million, 150 doesn't do it. Again, you can't pay 10% of your payroll with it, or you can't buy 10% of your inventory with it. It's not enough money to make it happen, to get you through the problem, particularly since the problem didn't last 6 months. It lasted over a year now. So we had a situation where, because the government, and this was a government decision internally, it was not the bill that was passed. They arbitrarily, the SBA, I don't know whether it falls on the Mnuchin, on the Secretary of the Treasury, or whether it fell at the director of the SBA, but somebody, and I suspect it was the director of the SBA, because frankly, they've now changed routes, but I don't know. And that could be because of the new administration. But anyway, they made the decision we're going to cap it at 150. We're not going to. Well, that was just, again, that was putting a tourniquet on that, on that wrist, but not shutting it off, just letting it drip instead of, you're still going to die from it. So it's just going to take you 6 months longer to die. So that's what they did. It was a big mistake. It was the big fallacy in what happened. The reason the economy is in the shape it's in right now, and that is not a good one yet. But that money was held back. Now they're going to increase that. Now they're going to say you can draw not 6 months of gross profit, but 2 years worth of gross profit, and you can pay it back over 30 years. Now, I'm going to tell you something real basic, and I don't understand why the government doesn't know this, but it's absolutely true. If you're taking $500,000 or whatever that number is, and that $500,000 represents 2 years of your gross profit, you've sold your business. You've absolutely sold your business. No business sells, almost no business sells for 2 times gross profit, for gross profit. Because again, businesses might sell for 2 or 3 or 4 times net profit, EBITDA, earnings before interest, taxes, depreciation, and amortization. They might sell for that, but that number is a lot lower than gross profit. Gross profit is before all of your general expenses, your rent, your supplies, your administrative labor, your legal fees, your accounting fees, your office supplies, your office computers, your computer costs, all of those things. It's before all of that. So if you think about it, gross profit for a lot of companies might be 20, 30, 40% of their sales, whereas their profit is only 4 or 5 or 6% of their sales. So if you're getting, let's say 20% for 2 years, you're getting 40% of your sales, and you would only be producing 5%. It's going to take you years to make that kind of money. So that's what your business would sell for, and you're getting it in a loan. You need to be aware of that. If you're taking the 500, that's fine. Money in the pocket is a good deal. But keep in mind that if you spend it all, you've actually sold your business, and you're going to have to rebuild it from where you're at. So just keep that in mind as you're going forward, because that's going to be the problem you're facing, and you may have to deal with in the next couple years. So anyway, that's about all we got time for today. I would say I see interest rates going up to about 6 or 7% by prime by August or September, and I think the mortgage rate will follow that pretty quickly after that. So that's where I think we are, and we'll talk a little bit more about it next week right here on Treasure Coast Solutions on WSTU Digital 1450, Martin County's Heritage Station.